Welcome, Momentum Investor, to the Momentum Investing Podcast. I'm super excited to have you here today because today we have an episode with none other than Marcus de Maria. Marcus has been investing for decades in property, in stocks, and lately in cryptocurrencies. He's taught people all over the world while working for people like T. Harv Eker, Success Resources, and of course teaching his own courses. What's been so amazing about Marcus, and I've worked with Marcus for a long time, is how he is able to make these complex subjects understandable, distillable, and how we can quickly go out and learn and do what he does. In this episode, he shares with you what he's looking for in an investment, what makes an investment good, what is it that you can take and use to diversify your portfolio and build your dream future as quickly and safely as possible. We talk about how businesses are valued. We talk about how to diversify your portfolio, and you will learn what he sees is the future of investing and how it's moving forward. So this is a very, very exciting episode. I hope you enjoy it. Make sure you stay to the very end because I have a very exciting surprise for you. And before you start the episode, I want to make sure to give you something. So we really appreciate you joining our podcast and listening. So we've created something just for you as a podcast listener here. You can go to the website momentumgift.com. That's momentumgift.com and get our Introduction to Property Investing course. It'll show you the 3 steps to property investing and the 3 most common mistakes new investors make and how to avoid them. So I hope you enjoy it. Go to momentumgift.com and grab that free introductory course. And now let's get right into the episode with Marcus so we can learn how to diversify our portfolio.
Welcome to Momentum Investing, property investing made easy. One of the world's top podcasts on property investing, bringing you the top experts in the field so you can learn firsthand what it takes to create passive income and take control over your financial future.
Hi, and welcome to the Momentum Investing Podcast. I am super excited to have our guest, Marcus de Maria, with us here today. Welcome to the podcast, Marcus.
Thank you so much. Real pleasure. Thanks for asking me.
Yeah, we're super excited. I think this is going to be something that's going to give a lot of value here to our listeners because you've done so many different types of investments. You know, you've never gotten stuck in one type. You know, you've done property, you buy and sell businesses, you do stocks, you do cryptocurrency. So with doing all of that, like, what are you looking for in investment? What to Marcus makes an investment a good investment?
Ah, nice general question. I like it.
Yeah, let's start broad and then we'll get into the details.
All right, fine. So obviously, look, it's all about diversifying. And well, actually, there's 2 schools of thought, right? There's one that you basically diversify, never put all your eggs into one basket. And the other train of thought is put all your eggs into one basket, but watch them like a hawk.
Right.
And it's interesting because, of course, once you get a lot of money, and a lot of money is different for everybody, you do have a bit of a challenge about where you put your money. I mean, that's what Warren Buffett's major challenge is, isn't it? He has too much money.
Yeah, poor guy, right?
Sorry for him. Sleepless nights he has.
Yeah.
But I think that for me, I'm looking for a variety of things, and that word variety is actually a word that comes up for me. I'm obviously looking for an asset that is able to rise in value. I know a lot of property investors are looking for cash flow. Yeah. So I might also be looking for a bit of cash flow as well, but I'm really a kind of a medium to long-term investor. Even in, all the things that I do, I never really do in and out very, very fast. I know some people do that. They kind of get a property and they do it up and then they flip it. That's never been our thing. And I say because my wife actually looks after the property portfolio.
Oh, that's so cool that you do that together. I love that.
Yeah. Well, she does it more actually. Right. She's the one that we do it together, but she does it. Whereas I do the stocks and the shares and the cryptos and the buying of businesses. That's mine. She doesn't come over to my side and I don't go over to her side. So
right. You leave her to run what she does well and she leaves you to run what you do well.
For sure.
Yeah, we do the same thing here, me and Gisela. Basically, I get to talk and she just does everything else.
Nice. Nice.
Yeah, it is. So when you're looking at investments, when you say like, and I love that you look at medium, long term, that you're looking at, getting things that go up in value. I mean, that's exactly what we talk about and what we try to teach our students is you don't want to be making money over the next week. You want to be doing it over the next decade.
Don't get me wrong. I go there with that mindset, but if something were to shoot up, and we might talk about this later, but one of my cryptos went up 14,000%.
Right.
So at that stage, what do? Do you kind of go, oh yeah, because most people have this long-term thing going on.
Yeah.
About well, I'll just let it go, and then once a year they might look. I'm not like that. I will look at it almost every day, just 20 minutes. And so therefore, when something is up 40, and I have another position 5,000%, at some stage you do go, well, I'm gonna just milk. I like to milk the cow, just take a little bit of milk off, 10%, 20%.
Right, and
so don't get me wrong. I'm not like buying
cryptos go up and then they crash, and
exactly.
Why wait until it crashes? Get paid while it's high.
Yeah. And never take all the money off the table, of course, because you don't know whether it's going to continue going up. So I do have that long-term view. I really do, but I'm not one of those that just watches it go up and go, oh, and then go into negative.
Yeah, right.
No. I'm not playing that game. No.
Well, that's good. I mean, you're a long-term investor, but you're not rigid in your strategy. You say, before the battle began, I made a plan, and then you do like Napoleon says, that once the battle begins, the plan is useless.
That's right. Yeah, that's right. That's so true. I think that's a really important to be flexible and rigid. Or being very firm about being flexible. Yeah.
Right. Yeah. Well, you know where you're going. It doesn't really matter how you get there. You know your principles and your milestones, but you'll be flexible on the way.
But I call it something else. I'm not lazy. Like some people, they really think about passive income. I am convinced. Now you're going to tell me differently, I hope. But I think there's no such thing as true passive income. I think you always have to do something. And so if you can spend 20 minutes a day, it's as passive as it gets. I mean, but you are focusing on it for 20 minutes. You really are.
Oh, absolutely. I mean, it's the same with property. I mean, we obviously your wife knows that, but we have our letting agents run the properties. They're doing their thing, and then at least once a month we have to go through all the reports, make sure that we're getting paid, and making sure that our accounts are up to date. But it's a couple hours a month, and I would call that passive income. If you're getting paid a full salary,
I'd call that pretty passive.
Yeah, if you work 2 hours a month for a full month salary, I think most people are okay with that.
You could split hairs and call it residual, but okay, let's call it passive.
Yeah. Well, it's as you say. Otherwise, the term passive income just disappears from our vocabulary. Because
right. And that's the utopia. And I think that really, in reality, you can make it passive by teaching other people how to do it. So for me, it is passive. My property is passive. Now you guys are property people. I have 14. That is probably nothing compared to what you and some of your people have. But I'm not a property guy. I'm an investor. So I am a property guy. I am an investor. So if I find that over here there is something that looks like it has a lot of potential, I'll start looking at it. But it all stays within, I won't start doing some really crazy stuff, although some people might think cryptos is crazy. But
but you learned it first. You got the knowledge first, and then you did it. You didn't just dive in.
I went deep down, research, wrote a book about it, mainly for myself, really, just put it all down, So yeah.
So when you say like, all right, if I see something over here that looks like this could be a really good potential investment, what kind of things is it that gets you going? Like, whoa, I got to take a closer look at it.
I like asymmetrical risk.
Right.
So
I do too. Let's explain what that is, because I know everyone doesn't know the term.
Yeah. So I like to it doesn't matter whether it's 100. It's all about percentages. Yep. So it doesn't matter whether it's millions, 100,000, 10,000, even £100. I want to make sure that if I put in this much, then I'm able to make this much.
Yeah.
So therefore I could lose this once, twice, 3 times, 4 times, 5 times. I could lose 5 times, but then once one of them comes good, then I get all my money. And by the way, I don't expect them all to
No, exactly.
win, but I don't expect them all to win either. And that's asymmetrical risk. And that I should stop talking about cryptos because that's what cryptos gives you. It gives you.
Well, that's where crypto becomes very, very unique, because as you say, you had a 14,000% increase in value. That you could have 139 deals go wrong, if I got my math right there, and yet you would have made a little money off of this deal.
Yeah, I mean, I put like 850. I mean, this is roughly, but $850, and turned that into 90,000. And I milked it along the way, so I took out 20,000. I still hold that position.
Right.
I'm waiting for the next bull market. The other one was 90 odd dollars. This was in Chainlink, which, by the way, it's already gone up. So don't just all jump into this now. Which went up 5,000%. So we're talking about, I think it was $990, which turned into 52,000. And at that stage, you start taking off 10, 20%. And if you take off, let's say 10% of 52,000, you have 5,000. Well, I only put in 900. So at that stage, it kind of makes sense. So that's asymmetrical risk.
So how would you go about, like, if someone wants, like, okay, I understand what Marcus is doing, how would you calculate your asymmetric risk? How do you analyze a deal to see that, because there's also, like, if this just has a 1% chance of success and it would 50 double your money, well, that's still a bad investment.
So it really depends what you're talking about. So for example, I look at the charts. I don't know whether you can do that in property exactly, but each, let's talk about stocks. So stocks have a chart, it has a history. So I can see in the past, where has it gone up to? Where has it gone down to? Where does it tend to get stuck a little bit before it comes back down or go back up? So I can see all of these things and I can draw lines and I can guesstimate roughly, and nobody knows, but I can guesstimate roughly where it is likely to go. But the other thing that I have is I have something called a stop loss.
Right.
See, I like that. See, that's my secret weapon over property, right? Not comparing. But that's what, actually, I have another one over property, right? Which is selling short, making money when markets go down. I mean, that's kind of why I do it, right? So I have a stop loss, which is an electronic order, which makes sure that I can get out. So I know that if I'm getting in here and I get out here, I know this is my risk. That's it.
Yeah.
It's 1% of my portfolio. I'm never going to risk more than 1% of my portfolio. But I'm looking to make 3, 4, 5, 6, 7, 8 or more. And that's the other thing, because once it goes into 3%, what I can do is I can raise my stop loss. I can put it below it. And then I've got my 3%, which isn't particularly asymmetrical, but it can carry on. It might be 68%.
Well, that means your worst case scenario is you make money.
No, not necessarily, because it could go down. I could lose my 1%.
Yeah, but that's what I mean. If you raised your stop loss, now your worst case scenario is you make money.
Correct.
So then you're just playing with the house's money at that point.
Yeah. The only thing is, and this is a kind of a negative against property, is that you do have to look at it 20 minutes a day. You do.
Well, I mean, the thing, to translate this into property, I mean, we can do similar type of due diligence. What we tend to do there is we'll do both a long-term evaluation of a deal and we'll do a short-term evaluation of the deal. So, for example,
what's the strategy here? Is it a buy and hold? Is it renting? Is it
buy and hold? Well, the principle would be the same for a buy and rent or a buy and sell, really. But I'll use a buy and rent because that's my favorite strategy. I hate selling a good asset. If the property's good enough to sell,
you want to be
every month. It pays me every month. But the followers of this podcast will know our term momentum investing. That is like, why would you sell an asset? You'll make more over time. But so what we can do is we can look at the deal and say, all right, so if the market value of the property is worth this, that's what's so great about property is, you can see this is what the neighbor's house was sold for. This is what this one was sold for. You can literally see if this property is worth 150K, hands down. Yes, if you put it on the open market, it would probably sell for 145 to 155. But that's what it's worth in good condition. It's not going to be worth more. It's not going to be worth less. You have that 100% certainty. And now
I like that certainty, and that again is what a lot of people don't like about securities.
Yeah,
because they do this.
Exactly.
Once you get over that, though, you realize that this is your friend, because if
Exactly.
I can constantly buy and sell, and then when it goes down again, I buy again, So what makes me laugh is that, if you haven't had that education, then, and you listen to the news and they kind of say, dun, 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 and, they tap on this, like,
Yeah.
good evening. The markets were very volatile today, falling by 1.2%. And everybody, 60 million people in the UK go, oh!
Yeah, exactly. The market is crashing.
Yeah, it's crashing by 2.5%. You go, well, that's nothing. And
Yeah.
it's like, why are you even bothering me with this information? 10%, and I'm interested. And then I'd get in. Everybody's like screaming and selling, and that's when we get in. So what basically happened in, and bring me back on subject, because I'm going to go off a tangent. So just bring me
Go
back.
for it. No. This is the good stuff.
Okay, well, what happened, obviously, I don't want to date this interview too much, but what happened during the COVID crash, when markets were down by 36 odd percent, in a very, very short period of time, depending on what market you were looking at, of course, gold only fell by 12%. But as it went down, my students were buying, getting in. Everybody was selling, we were getting in. And then as it went down, we were getting in more using the VCA strategy. So adding 25% more. So we had a nice average price, which was quite low. When it then went back up again, some of my students made 50% on their entire account, while other people had lost.
Which is insane. And there, what you're just saying there with the VCA, basically, if you buy something at 100, it drops, you put in another 25%, which lowers your average purchase.
So it's 25% more on top of what you invested there.
Exactly.
Right? So if you put in 100, you put in 125. The next time it's 156. The next time.
And as the market crashes, your average purchase price is going down.
Right.
And then when it turns up, you take all that profit and have a party.
Well, that sounds good. So what we do is we aim for 15%, and then for the first time we would put a stop loss underneath to secure our 15%. But then, because most people would get out, they would go, "Oh, I've made 15%," and they get out. No, because now, before, the short-term movement was down, but now the trend is up. So how long could it carry on going up? So keep raising that stop loss, raising that stop loss, raising that stop loss. And by the way, before everybody goes, this sounds like I'm going to have a heart attack, this takes days. It's not like this is within minutes. So you're sleeping, and then you're looking at it for 20 minutes again. Oh, there's nothing to do. You're sleeping in. The next morning, you look at it again, or evening, or day. It doesn't matter when you do it. For us, the market doesn't need to be open. We don't have that emotion, of that I couldn't stand. But on the next day, you have a cup of tea. You're like, oh, what's happening today? Or in the evening, the market's closed. Absolutely perfect. Yeah.
Oh, that's awesome. And I know obviously the art of that is a big part of it is how to put that stop loss in, so you don't just get a volatile curve in the market that taps you out before it goes up again.
Yeah. So when you're trading, we always use a stop loss. But that example there, I jumped a bit, was investing. So with investing, there is no stop loss. And in fact, we're trying to get in again. We're not trying to get out. We're trying to get in again as it goes down. But here's the thing, because I know what people are thinking. We've been teaching this for a long, long, long time. And I've been trading for over 20 years. So I know they're going, yeah, Marcus, that's great, unless it goes to zero. Right? So you're getting in, getting in, getting in, getting in, getting in, getting in, and then you lose all your money. So we only get into what I guess people would say are blue chip stocks that really can't go to zero, or the chances of going to zero are very, very small. And everybody knows them: Facebook, Google, Apple, Microsoft, Intel, Cisco, Walmart. You know them. Disney.
Yeah, I mean, Amazon was not about to go bankrupt during the COVID crisis.
Right, quite the opposite.
It wasn't going to happen.
Yeah, that's right. That's right. And you've got to use your brain a little bit, right? You're not going to go. And by the way, I know plenty of people that did. They waited for everything to crash, and then they go, "Ooh, these airline companies, they look pretty cheap." And you go, "Well, hold on a moment, just without having to be a professional. If no one is flying during COVID, let's not get in." Right now, and you do need to, and that's why it's a good idea to have a trading buddy that you can just talk to and just say, "Look, what do you think?" They go, "Well, let's not buy into restaurants right now if nobody's going into restaurants." "Oh yeah, good idea." So let's not get into cruise ships right now. I don't know, thinking a little bit. You do need to think a little bit.
Yeah, and that would be, I mean, like Tony Robbins talks about, you have your different buckets where you might have a 10% of your assets or even less could be your, have fun and take big risk bucket.
Yeah,
You do
absolutely.
that and put into that, but you don't put your like security bucket into airline
No,
stocks
oh
when
my
nobody's
goodness.
buying.
I wouldn't necessarily even put that into stocks necessarily, like, so like cryptos, I would say, 5 to 10% of your investment capital goes into cryptos, because remember, it's asymmetrical. So
So
you don't
that's
even need
enough
that
to
much.
make 90,000 off of a small
Yeah.
investment.
You don't really need that much. Now, obviously, people are like the greed glands. So they're like, oh, I'm going to put 50 in. But then you're getting away from the buckets. You're getting away from the asset allocation. Yeah.
Yeah. And let's talk more about asset allocation, because that's actually really interesting. Because most
Okay.
of, I would say, our community, we are property investors. That's what we do. But there
Lovely.
is a reason why this community, well, why this podcast is called Momentum Investing and not Momentum Property Investing. It's
Well, it
because,
says on your thing, it says momentum property education.
well,
So,
that's because I am of the company Momentum Property Education.
ah,
Because we just teach property, because I don't do a lot of stocks. I have other people help me with stocks.
okay,
But what we are, first and foremost, just as you said, we're investors.
right.
So yes, we focus mainly on property, but we also like to have other assets. So how do you look at your asset allocation? How do you try to divide that?
Yeah, so I think, the majority of it, I would say, is probably and I'm just looking about in investment. I'm not talking about business. I'm not talking about anything like that, although you could look at the entire thing. But if you're just talking about money, um, I don't know whether this is quite aggressive, but we would say maybe, 60% is in property.
Right.
60% is in property. And then we would have 10% or maybe in cryptos. And then stocks and shares is the rest, around 30%. That's roughly.
Right. And how about if we look at the stock allocation of that? I mean, the property side, I'm fine with that. We know what we're doing. But the stock side, how would you split that? Would you be putting that, would that have sub buckets, so to speak, in it?
Yeah, for sure. But that just happens naturally, because what happens is that when you see a stock that is basically, and this is the investing again, because we have two strategies. The VCA is the investing, and the buffalo. I'll show you the buffalo. This is the buffalo here. Got to get a buffalo. This is the buffalo. Because bulls goes up, bears go down, but the buffalo goes sideways. So we pick up, buy, sell, and sell short, buy back, making money when markets go
That's more
down.
the trading style movement.
Yeah, the trading style, 20 minutes a day. Absolutely. So then we basically just naturally that happens, because as you're getting into a company, let's say Facebook, and again, not a recommendation, Facebook is way overvalued right now, way
That's
overvalued.
at the time of this recording, which is
Correct.
super important, because in a week, the life might be completely different. So
Absolutely.
don't here comes the disclaimer. No advice given in this podcast by Marcus or myself on a certain stock, a certain company, a certain crypto is actually advice to buy it. We're just giving you principles.
Yeah.
Now we're safe and covered. You can say whatever you want now.
Get into crypto as buy. Okay. So what you need to do is, as you're investing, because remember, we are looking to get in several times, and we know that in advance, and we have a little calculator where we put in, okay, how much am I allocating? Well, 30%. Okay, but let's say I'm getting into two stocks. It'll tell me how much to go in on number one, but it has enough left over for number two, number three, and number four, just in case I need to get in. So the asset allocation kind of happens automatically. And
Right.
sometimes you're in cash quite a lot while you're waiting for some of
Well, I'm
these.
waiting for these things to go
Yeah,
down, or
absolutely.
they shoot up for me to do other stuff with my money.
Yeah, absolutely. So if it goes up, then, and I have an allocation that I was supposed to, in case it goes down, I will go into another stock, which happens to be going down right now. By the way, I just want to go back to that other point that we opened up a discussion about, it can't go to zero.
Right. Yeah. Let's get to that.
It's
That's an
really important that
question.
people realize, like, what can't go to zero, because they might go, well, anything can go to zero, right? No, but if you think about it, that's not true.
Yeah.
Like, an individual stock can go to zero, but what if you bought this thing here, right? What if you bought something like this? This is supposed to be, by the way, a basket, okay? And this basket has lots of shares in it that is already made up for you, all of these baskets here, okay? And this is called an ETF, Exchange Traded Fund, ETF, which has been put together for you. So my question for you, and I'm going to test you now, which is just horrible when that happens.
Uh-oh. Yeah, I'm supposed to be the interviewer. What are you doing?
Not right now, not right now.
Just flip the script. All right.
Okay, so here we go. I'm sure you can do it, which is that can a basket of shares that are the top shares in the US, or Sweden or Denmark or whatever, can they go to zero? Can that whole basket of the best companies in the world go to zero? Yes or no?
No, generally, I mean, occasional ones of them could go to zero, but it would probably
individual stocks can go to zero. So don't invest in individual stocks unless they are blue chip stocks that you know, that you use. Apple, you know, and then new ones coming out. Oh, what a great company, you know. But yeah, you're right.
The entire one to go to zero, it would take that the entire economy, the entire world as we know it, goes to zero, which means whatever money you didn't put into it is worthless now anyway. So
you'll have bigger problems. Exactly.
Yeah, you've lost anyway. That's World War III and everyone passes away. Then yes, your stocks will go to zero. In every other case, you're not going to see, as you said, imagine a combination of imagine what would have to happen for Walmart, Facebook, Amazon, Google, Cisco, and Netflix all to go bankrupt at the same time.
That would be terrible because I wouldn't be able to watch Netflix anymore.
Exactly. Well, you know, Disney Plus is coming out, so you're fine.
That's true. Ooh, the competition. Yeah, and also I think Amazon Prime. There's now 3 kind of bigger ones. Yeah,
you'll be fine. But I mean that it would take such a cataclysmic event to put all those companies out. So I completely get what you mean. As long as
so we would invest in something like that. And by the way, we only invest in it when it's dropped a certain percentage. So again, we're playing it real safe, right? We never get in at the top. We always wait. And people say, yeah, but what if it doesn't come down? Well, then we don't invest.
Yeah.
You know, it's like property, you know, it's like, I really want that property. Well, why? You're not going to live in it. You're an investor, right? But it's a little bit, you know, like, yeah, but you're not going to live there, right? So but it has to come down in price. Otherwise you can't get into it. That's what I mean by investing. Yeah. You know, wait for it to come down in price. And they always do. You just need to be a little bit patient. Warren Buffett will wait an entire year before, you know, he gets in.
Yeah. But I love the quote, by the way. I was just thinking about it when you were talking about how, like, when the market was falling by 36%, that is like Warren Buffett is saying, you know, when other people are greedy, be fearful. When other people are fearful, be greedy.
Absolutely. Yeah, absolutely. And that was definitely a time when a lot of people were very fearful. And listen, by the way, let's talk general principles. You know, a successful person and a not so successful person, here's the difference. Oh man, I really don't want to do this because I don't feel like it, right? I might be like lazy or tired or procrastinating.
I've never said that.
No, you've never ever in your life.
Never ever said
that. Then, if you never said that, I've never said it. I've never even thought it. How about that?
Exactly, I would never.
And then the unsuccessful person, due to that emotion, therefore doesn't do whatever they know they're going to do or what they should do. A successful person, they're also feeling lazy. They also don't want to do it. They're also tired. They're also procrastinating, but they do it anyway. That's the only difference. So when it was crashing, did we want to jump in? We were like, okay. And then we were like, hold on a moment. What are the rules? See, we have rules. Yeah. See, most people don't have rules. So it's like, well, the rule says get in when it falls 20%. It's like, well, it's fallen 20%, so we should be getting in now. Yeah, but shit, COVID is happening, it's crashing, you know. And that's the difference between somebody who's successful and not. They did it anyway. They were like, you know, I got all these, you know, emails from people saying, listen, can I swear on this thing or not really?
Well, you know, you can do.
Okay, I was pooping my pants.
There, that works. There you go.
You know, okay, I was pooping my pants, but I remember what you said, Marcus. Follow the rules. So I got in, you know, like this. So they were just following the rules, And that's why they were successful. Did they want to do it? Were they emotional? Absolutely, they didn't want to do it. Absolutely, they were fearful. Absolutely.
Oh, absolutely. One of my mentors, he's the founder of one of the founders of one of the largest private banking banks in Switzerland. And, he had clients crying on the phone. He'd made them like 40% the year before, and now they were losing that same 40%.
Yeah.
And, they were crying, and he's like, well, do you have any more money? We should be getting in right now.
Yeah.
Some of them were like, yeah, and did it. And now they are, now they're, sending him flowers and whatnot.
Flowers? What, after making millions? Flowers?
Well, I'm sure there is a couple mountain bikes and stuff in there too for him. He's fine. I'll tell you, he's fine.
See, that Warren Buffett quote, I've got my version of that, because when you say, because people don't tell you, they say, when others are fearful, be greedy. And that sounds great. But what do you do when others are fearful and you're fearful as well? Yeah. What do you do then? It's like great being greedy, but so I kind of say, what happens when others are fearful and you're kind of feeling fearful as well, but you have rules that dictate that you should be fearful right now. So you're kind of acknowledging the fact that you're kind of human.
Yeah, and that's what's going to happen every time. If it's, as I talk about courage with my kids, courage isn't the absence of fear, it's the acting in spite of. And
where did you get that from? That is a really good. Where did you get that from?
Oh no, it's some movie. I don't know. It's some kids movie, I think.
Kids movie? Come off it. That's what we teach at the Millionaire Mind Intensive.
Oh, it could be that too. Yeah, it could be that too.
In spite of
I'm sure Disney has said that more than once.
Of course. Are you kidding?
That is such a classic. But yes.
Yeah. That's why people love Disney, by the way. And that's why, I love Disney stock. That's why whenever Disney goes down by 20% from a recent high, I tend to start getting in because they have the X factor.
Yeah.
Apple has the X factor. I always ask people, I say, well, do you go to, do you buy Disney products? They don't even know they're doing it. They go.
Well, I've loved seeing their shopping sprees they've been doing over the last few years. I mean, I was just reading an article recently about when they bought Marvel. Obviously, that was a while ago. But
I was just about to say that, right? People don't know that when they're watching like the Avengers and whatever, it's like, that's Disney.
But the insane thing, though, is they bought Marvel for $3.4 billion. And everyone went, oh, my God, they're crazy.
The last bill?
Well, the thing is, that was right after the second Iron Man movie and the first Captain America. So they'd never done an Avenger. But the next movie,
I think you're a fan. I think you're a superhero fan.
A little bit, right? A little bit.
I'm imagining you now with the figurines, at home, and like, when your wife touches them, like, get away! Don't touch those. They're pristine.
I'm not that bad, but I will give you my butt here, and I'm actually going to recommend another podcast that is brilliant called Business Wars. And Business Wars, they do like two companies facing off. So it's like Nike versus Adidas, and they did Marvel versus DC. Okay. And that was Candyland to me.
Just quickly, I know it's not the topic, but then who won in the end? Because Marvel has got all these characters. DC,
well, it was
they've got some good ones.
I'll cliff notes it for you because I really got into this. But what happened was, obviously DC was the big one with Superman and Batman, and
right, they have some.
They had the Justice League of America, and Marvel was no one. They were nothing. And then what's he called? Stan Lee. His uncle owned Marvel, and he said to Stan Lee, he's like, "Hey, DC just created Justice League of America. I want you to just model that. Do something like it." And Stan Lee was about to quit. He's like, no, I'm not writing this crap anymore. And then his wife actually told him, like, no, you know what? You've always wanted to write a real novel. Do that with this. Write a real story with real characters, not just the pow, not just the sound effects. Do something real. And he created the Fantastic Four, which were, these heroes that were pained, that had all these different sides, that they weren't happy to be heroes. There was this depth to them. And then he just started rolling these out, and DC had no idea what they were doing. They were looking at Marvel and going like, I don't get it. And they analyzed and like, maybe it's that they have red on the cover. You know, they just didn't realize that the story was fundamentally different. And all of a sudden Marvel passed DC. Well, over a decade, they passed DC
did not know that.
in sales.
I did not
And then
know that.
DC got, you know, the Batman franchise and got on TV.
Yeah.
And then
what about Spider-Man? Who does that belong to? Spider-Man.
Well, Spider-Man is Marvel, but
Okay.
the first like the what's he called, Tobey Maguire Spider-Man ones.
Yes.
Marvel just licensed the Spider-Man, so they only got like $25,000 for that franchise, which was insane. But then they took it back with the new one, and they had Jon Favreau was the director who did Iron Man 1, and that just launched Marvel Cinematic Universe.
And he was in it, right? He was in it.
Yeah, well. He puts himself in all his movies. I love Jon Favreau.
Yeah, he's
and
awesome.
then you know, and now to come back to our actual subject, Disney spotted that. Disney spotted that their superheroes were in a way, you know, because Batman has, other than the Christian Bale Batman, which I really liked, all those movies and Superman have been very one-dimensional characters. You know, you don't really get to know the person. And they spotted Marvel, and they bought Marvel for $3.4 billion. And everyone said they overpaid, that they were mad. And then the Avengers came out and was $1 billion movie, and everyone was like, wow, they got a deal. They underpaid like crazy. So that's my long way of saying they found a deal. And I love Disney for it, because they've found multiple of these. You know, they bought Hulu in the same kind of way. Yeah.
The whole thing with Pixar as well was very.
Oh yeah, that's cool though. Though that is almost more of a Steve Jobs kind of pulling that off. That was really cool.
Very
so that's
nice.
Well, I think on that note, I know everyone wants to learn more about what you do and how you do it, and so do I, by the way. And I'm going to be talking to you and Dennis about it. But I know they want to reach you.
I talk to you about like cryptos. But before I do that, I think it's important that when it comes to trading and investing, especially around this time, and I know you said about, you know, it depends on the timing of this, but you know, there's a big like difference between what's happening with stock prices right now and what's happening in the real market. When you look at outside, you look at businesses closing, Marks and Spencer's, you know, getting rid of 7,000 jobs and things like that. This is very real, what's happening out there. And that's called a divergence. And when that happens, prices have to come down eventually.
Right.
But before something like that happens, there tends to be a blowout top where everybody is euphoric. And that's what's happening right now if you look at the stock market. So I think that we need to position ourselves right now to be taking advantage of what's happening in the market. And the way we're doing it is we're buying ETFs of gold and silver, physical gold and silver, into gold miners, junior gold miners, and ETFs. So lots and lots of them in there.
Right. Yeah. So not just one gold miner, hundreds of them.
Unless you want to take on more risk, then you just buy one really good one. Which we're also doing, but it's less money because it's more risk, correct. The other thing is, most people don't realize there's something called a reverse ETF. So when you buy it, the reverse ETF, if the stock market goes up, the value of your ETF goes down. But if the stock market goes down, the value of your ETF goes up, but you treat it as a buy. So if it goes down in value, you just buy some more and do the value cost averaging strategy on there.
All right. So you do the exact same principle, just that you're playing the exact opposite path of the market.
Correct. So that's what I wanted to say. And the other thing is that gold and silver have been the traditional hedge against you know, any kind of turmoil in the markets. But now there's a new one, which is cryptos.
Yeah.
And I think it's more of an investment than a hedge, whereas gold and silver really is more of a hedge than an investment.
Yeah,
because,
I would definitely agree.
Okay. But cryptos now, especially since we've been in a bear market for the last 2.5, almost 3 years, the average bear market generally is 2 to 3 years. We're looking to come out of that now. And, you know, we're positioning ourselves massively into blockchain 1.0, which is Bitcoin, Ethereum, which is blockchain 2.0, But there's some very interesting blockchain 3.0s now as well that you really need to start researching. And there's companies that are working with 200 of the largest banks in America. So there's real use cases of cryptos coming up that I think your readers and again your listeners, really only 5 to 10%, but you really should be looking at it. Start getting, because you will be so glad you did in the next 5 years or so. You will be, because the asymmetrical risk is insane when it comes to I mean, I've been doing this for 20 years, but I've never had 14,000%. I've never had 5,000%. I've never had that. And if you look at my positions right now, my top positions are 5,000, 3,000, 2,000, 1,000, 1,900. It's insane.
And that totally compensates for all the losses that you'll have as well. It's not even close, I can imagine.
Totally. Yeah, absolutely. So just a shout out there, do take it seriously. I know people don't know about it. I get it. But do start reading up about it. Obviously, we can help with that. But even if you don't learn with us, please make sure you do look at it. Then decide.
Well, there. So if they're going to come and learn from you, because I definitely think if you want to diversify with stocks and with crypto, our clients that have worked with you are over the moon. They've worked with you for a long time now, and I know they're making money, which is that's a good resume. So how do we reach you? How do we learn from you?
So the main way is by just downloading my main book, which is over 100 pages. It's people say, wow, this is all I need then. And I'm like, yeah, maybe I should take some of the stuff out there. But, which is on investment-mastery.com. So www.investment.
And what is the price of the book?
So normally if you get it on Amazon, it's $9.97, but you can download it for free because it's a download.
Wow, that's awesome. That's so nice of you. So everyone who wants to get the book on stock investing, and I'm sure it touches on crypto as well.
A little bit towards the end, and hopefully, there'll be some webinars that we're doing, live webinars, and they're very interactive. We field questions, and I'm there for half an hour after the webinar's closed because people have so many questions about crypto.
I can imagine.
Can it be shut down? Which it can't. Things like that. So hopefully we'll be sending out information to all of those people that download my main book. Yeah.
That's amazing. So investment-mastery.com.
Yeah. I don't know whether you can write it somewhere.
I'll put it in the show notes, but so for everyone, if you're ready with your phone, investment-mastery.com. Go download it now before he realizes he should be charging money for it. So that's really nice of you to give it to us.
When I first started, I was helped by people, and people will go, oh, yeah, blah, blah, blah. But as I've been around Tony Robbins for a long time, and he always talks about to be fully fulfilled, you need the last two things out of the 6 human needs, which is growth and contribution, which I never understood for years. Like, why am I helping other people? I need to help myself, But it really is true. It really is true. The other thing that I wanted to say,
100%. That's why we do what we do, right? It's
But you can make money from it as well, right? It's not like it's just but
not charity.
No
contribution.
Yeah, absolutely. And then we have families. I'm very excited about. Like, for example, in Austria, we have one family where they have 12 family members that are doing this together in 3 generations.
Oh, that's so beautiful.
Grandparents, parents, and sisters, and then the children. It's amazing. It's absolutely amazing. The results.
That's like Thursday night TV. You watch Marcus deliver the weekly updates on the market.
So you know what they said? They said, so this is basically what they do at dinner. They say, so how was school? Oh yeah, it was great. So how was university? It was great. Right. Okay, great. So what are we going to do with silver? Are we going to buy some? And we need to sell short Apple. That's basically,
So it's like the perfunctory, like, is everyone okay? Everyone's fine. Let's get into the stocks.
Yeah, absolutely. Because one of them's 12, the other one's, 17. And I mean, what a gift to give this to them so that they can do this for the rest of their lives.
Already having that mentality. I love it.
And if you get into cryptos, which is the future of, because it's backed by blockchain, right? It is getting into everything that we do. It's the future of finance, so learning it at that age, absolutely incredible.
Awesome. So everyone, if you want to learn more from Marcus, go to investment-mastery.com. download the book. Keep your eye open for their webinars that are also free, where they'll help you and show you the basics, show you how it's done. And then obviously I recommend that you work with them if you want to learn more. So Marcus, thank you so much for joining us.
That went so fast.
Yeah, exactly. All of a sudden we're up on, I think we've been going for like 45 minutes, but I loved it. It was a true honor to have you on the podcast. I hope we have you on in the future.
Absolutely. Absolutely. And listen, thank you so much for your time. And I hope your listeners got some value out of this. And I look forward to helping them in any way that they want.
100%.
Thanks.
So thank you everyone for listening, and stay tuned. I got another exciting message for you before we shut off. So thank you so much. Thank you, Marcus. See you again soon.
Take care.
Thank you so much for joining us. I hope you felt you got a lot of value. I apologize for my little tangent there on the Marvel comics. I get very inspired when I think about how different companies grow and how they expand over time. And that's why I love talking to Marcus, because he's been able to identify some of the top companies in the world, some of the top potential, as you heard with his returns in cryptocurrency. So that just makes it all super exciting for me. Now, I promised you a surprise if you listened the whole way through, and you did. So here it comes. Our next episode, next week, our guest is none other than the legendary Kim Kiyosaki. Yes, we have Kim Kiyosaki coming on the Momentum Investing podcast. I've known Kim for a long time. We had her as a keynote here in Sweden at one of our first Empowered Women events. And she is super busy, but she agreed to take some time out of her day to spend with us. It was a great interview because I got to ask questions from you guys in the community, and she answered them brilliantly. That episode is coming out next Tuesday, so make sure you subscribe to the podcast so that you get a notification the moment the episode comes out. Kim is amazing. I mean, she is, if you don't know who Kim Kiyosaki is, she's the co-author of the book Rich Dad, Poor Dad, which has sold in over 30 million copies in over 100 countries all over the world. And the book has even been featured on Oprah. So you know it is a good book, because in Oprah we trust, right? So it's an amazing episode. Make sure you listen to it. And before you go, remember, I want to give you that gift. Go to momentumgift.com and join our free introductory course to property investing. Thank you so much again for listening, and see you next week. Make sure to subscribe. You do not want to miss Kim Kiyosaki sharing what's going on in the market. How are we going to act in the years to come? How do we protect ourselves? How do we build our portfolios? How do we project manage? How do we handle our portfolios, and what she is working on personally to grow right now? So I'll see you next week.